question. The question number 1 is basically Mr. Sharma is an employee of ABC Limited. So we are talking about an employee. So when you say an employee, the probable sections, what could be the sections? It could be related to salary, that is 192, or PF deduction, that is 192A. So it is Sharma, an employee. So when you read an employee, the possible sections that could be there in income tax and TDS is 192 and 192A, possibly. So that's what probably the point I'm trying to say is things should run in your mind. The provision should run in back of your mind to see what will be the question related to about. So it's about a question of employee of ABC Limited, and they have given a date. So now the date is probably relevant to understand for what period is he working in that particular company. And he is resigned on 31/3/22. So exactly. So that is what is it. So it's going to be about a TDS computation relating to salary or PF related. And he has withdrawn 60,000 being balanced from the EPF account. So now it is restricted to only one section, that is 192A. We are only going to understand 192A to understand whether tax deductions will be available or not. So what they want us to provide is discuss with reasons. So they want us to provide reasons on whether chapter 17B. 17B is basically the TDS chapter. So this TDS chapter, this 17B, that is 17 heading B. So that's what chapter 17 heading B discusses about TDS provisions. We need to discuss whether it is attracted or not. What is the net amount receivable by the payee, that is Mr. Sharma. So this is what the question is about. So as we said, we need to understand what provision 192A is about. So 192A is basically the organization, that is, let's say EPF organization pays to an employee, right? So they pay PF to an employee. When they are paying PF, that is the employee is withdrawing the PF. So withdrawing the PF. So this EPF organization, the trust of EPF, the employee provident fund organization will probably be paying the provident fund to this particular employee. Now in this payment, what is the tax deduction? So it basically the provision says, whenever you are making a PF payment, make a tax deduction of 10%. Now in this 10%, every TDS provision, probably we have to understand what is the limit. So one of the primary factor of this TDS provisions is limits. What is the limit that is applicable above which only your TDS will get deducted? So we need to understand the limit. So what is the limit for this section? It is 50,000. So 50,000 is the limit for PF deduction. So if it does not exceed 50,000, then there is no TDS involved. So it has to exceed 50,000 for applicability of section 192A. And are there any other condition? So we call this exceptions or exclusions. So every TDS provision will have certain exceptions, certain exclusions. So we need to understand what are the exceptions or exclusions for 192A. So what does 192A says? When it says, when an employee is for a period of plus 5 years. So which means he is in employment for a period of more than 5 years. So if he has been period of 5 years, when they use this word 5 years, they are using the word continuous. So they're trying to say if an employee is continuously working for a period of 5 years or above, then this TDS is not applicable. So it's an exclusion that we are talking about here. So if it is above 5 years or more, then it is not there. Similarly, he could not work for 5 years or whatever period that we are talking about because of health. So some health that he has there, he has to discontinue. He has to discontinue because of health reason, or in fact, let's say the business that we are talking about, in this case, if it's ABC Limited, if the business is no more in operation, that is discontinuance, closure of business. So it could be either health of the employee or closure of the company. The company could wind up. Now, the reason for me resigning or me coming out of the company is not me, it's the company. So obviously you cannot question me why I have not worked in that organization for 5 years, right? So that's a very basic, probably a basic logic that will apply here. So based on this logic, there is one exclusion which talks about closure of business. Another exclusion is about discontinuation of health. The third exclusion is relating to if he has worked there for continuous period of 5 years. So these are the three exclusions. So with this exclusion, now we'll understand this problem again. We'll go through this question again to see what exactly is happening to this Mr. Sharma. So now, basically, Sharma an employee of Ms. ABC Limited since 10 to 2004, 2017 to 31/3/2022. So we need to understand the period, right? So as far as this period goes, what is the period? The period is, it is what period? It is between 2017. Let's take example for, if we had worked from 1st April 2017 till 31st March 2022, it would have been exactly 5 years. But here you would have probably worked for 4 years. So 4 years plus, let's say 11 months or something, and some days, some 20 odd days or a little less than that. So this is what is the period he has actually worked in that particular organization. So he has not worked for more than 5 years. So in this case, what happens here is he must, tax must be deductible under this. One more thing probably we can add to the answer is, generally TDS provision says deduct TDS at so and so rate. In our case, we said deduct it at 10%. But in case the employee has not provided the PAN, assuming the employer has not provided the PAN for all these years to the employer, then what happens? 206 AA applies. So what is 206 AA? The rate in force, the Income Tax Act, or the 20%, whichever is higher. So here there is no rates in force. It is only Income Tax Act or this 20%. So what is this Income Tax Act? It says 10%, right? And your 20% in this case. So the 20%, whichever is higher. So in case if there is no PAN, then 20% will get applicable. And for all payments to domestic payments, while computing this TDS, there is no surcharge, no cess, right? So this is what the provision is. Now we'll go into see how to go about this answer. So basically it says, as per section 192A, whatever is the accumulated balance due to an employee participating in recognized provident fund. So this entire thing is about only recognized provident fund. It is not about unrecognized provident funds. So if it is total owing, so whatever it says is that any person, so whatever, let's leave this categories relating to the PF Act and other things. Yes, probably you should understand that whether you should actually quote it in the examination. Of course, it will be great if you're able to quote it, but you can quote it or you can leave it aside and go proceed also. So basically it says any person who's authorized to pay on behalf of PF when making that payment shall deduct 10% at the time of accumulated payments, accumulated balance. So whatever payment is being made, 10% shall be deducted and paid to the employee. So it says it is only crossed 50,000. So all this we discussed, right? So it's only crossed 50,000. So what is the next thing that they're saying? They say, according to that, it is not applicable. The PF deduction is not required if it is for continuous service of 5 years or more with the employer. Then it would be excluded from the total income of the employee, which means it shall not be tax deductible in the hands of the employee. So here he has basically withdrawn 60,000 after rendering a resignation from ABC thing. So here he has not rendered for 5 years. So without rendering for a continuous period of 5 years. So this payment, what will it happen? Whatever is being paid, 60,000 into 10%, that is your 6,000. So that's what they've quoted here. So reducing this, you will have to pay the balance. That is your 54,000 after reducing your 60,000. So this will be your TDS payment as far as the payment is concerned. So for the question, yes, TDS must be deductible. It will be deductible at 10% and for so and so reason, right? So it is assumed that Mr. Sharma has furnished PAN. So he has furnished the PAN. So once he has furnished the PAN, it is fine. It is 10%. If not, they say that with effect from declaration of form, non-deduction of tax and source. So it will be deductible at maximum marginal rate. So typically we were talking about two things in our earlier problem. So we'll add a point to that. We said 206 AA. We said there are IT Act, rate in force, and then your 20%, whichever is higher. Now here what they say is, as far as Income Tax Act, an individual is taxable at slab rate, right? So an individual is taxable at slab rate. So in this case, what they are saying, whenever it is relating to this individual, they are saying it will probably, the maximum possible tax rate of that person is called maximum marginal rate. So which will be 30% plus 37% surcharge and plus 4% cess. So this will somewhere give around, let's say 40% plus. So that percentage will be the maximum marginal rate. And whatever TDS that is supposed to be deducted under this act is 10%, and this is 20%. Now, whichever is higher applies here for these employee related information. So what happens is, he might give a declaration under form 15G saying that, see, my total income itself is less than 2.5 lakhs. So I need not file return of income. There is no requirement of any tax deductions. So if he is given that, then fine. If he is not given that and he has also not declared his PAN, then in that case, the applicable rate will be the maximum margin rate. So this is an additional point that we can proceed in the answer to convey to the valuer that you have understood the provision as much as one could understand. So that's what the valuer expects out of you. It is the understanding of that particular provision. So that is about question 1. So with this, we understand what happens when a deduction is supposed to happen under section 192A, and what happens when a PAN is not declared, and what are the possible scenarios that you could avail. That is, by declaring form 15G, you could still claim exemption. So moving on, we'll go to question 2. So this question 2 is basically about a bank, Maya Bank, as credited. So Maya Bank is paying interest, 73.5 lakhs towards interest on deposits, right? So what is interest on deposits? It is 194A. So whenever interest on deposits is paid to the concerned person, TDS must be deducted. So when a bank is paying to its account holders or deposit holders, TDS must be deducted under section 194A. But here what they say is, these interest are deposited in a separate account. For what purpose? It's basically for using core branch banking solution. So for some monitoring purposes, for some, let's say it is for an internal bank process. For an internal bank process, this bank is crediting 73.5 lakhs in a separate account for some internal monitoring purposes for the usage of CBS. So CBS is your core bank branching solution. When you say CBS, it is which links the bank. So instead of transacting only in your branch, if you are able to transact in any other branch and everything accounted as one, it is called core banking solution. So no tax was deducted at source. They say that tax was actually not deducted at source in respect of that interest deposited, so credited, even where the interest in some depositors. So this 73.5 lakhs relates to multiple depositors. So it relates to multiple holders. So they say that even if some depositors, for some depositors, even when the interest exceeds 40,000. So the rule under section 194A is, if your interest exceeds 40,000, TDS should be deducted by that bank. And when you say 40,000, when a bank is operating under this core banking solution, it applies to all branches together. If you have account, one in Tamil Nadu, one in Maharashtra, it is put together is 40,000. But if the bank does not maintain this core banking solution, then it is 40,000 for Tamil Nadu, 40,000 for Maharashtra branch. So it is for each of the branches, 40,000 applies. But here they say it is basically for the core banking solution. So some deposit exceeded the limit of 40,000. Now, the assessing officer has disallowed 30% of interest. So what provision is this? Under 40 clause A 1A, where it says, if TDS has not been deducted on some domestic payments, if it's international payment, it is 1, where your 100% of expenditure is disallowed. But here in 1A, in this subclause 1A, if the TDS has not been deducted under this 40 clause A, 30% of expense will be disallowed in the year in which it is not deducted. Subsequently, if deduction has actually happened in the relevant year, then this will be allowed. So that's what 40A is. So it will be disallowed in the year of non-deduction, short payment or whatever. It will again be allowed in the year in which it's actually it is paid. It's paid to the government. TDS has been deducted and paid to the government. So assessing officer has said, see, you have paid interest, you have accounted, you have credited interest to various accounts where this accounts relating to this, whereas various depositors has interest more than 40,000, interest more than 40,000. So you should have deducted TDS. So which means I will disallow this 30% of interest expenditure and also levied penalty under section 271C. 271C is basically the older section of this 270A in what is currently in place. So 271C is basically when you have underreported income. When you have underreported income or misreported income, what happens is you are liable for certain penalty. So if it is relating to this TDS, this penalty can be levied under section 271C. Now decide the correctness of the assessing officer. So as a student, I'm supposed to examine whether the assessing officer's action is correct or not. So let's see how we will proceed about it. So as we said, this core banking solution, if an interest is being credited more than 40,000 to an account holder, then for the TDS must have been deducted. Here, what they say is they are actually not mentioning that they are depositing the interest into the account holder's account. They're only saying a separate account for monitoring purposes by using CBS. So which means the question is not saying it is actually deposited to the account holder. So that's what we are going to understand. What are the provisions if it is actually not accounted to the account holder? So if you actually see, we'll first see what explanation is said. So basically, when there is an interest other than interest on securities in 194A, whenever it is credited, it could be on interest payable account or even a suspense account, right? So they say even if it is not actually booked into the depositor's account, even if it is some suspense account or even by any other name, they say while crediting interest, TDS must be deducted under section 194A. So now it looks like straightforward, since even though he has not accounted it to the person, this account for core banking, whatever they're doing for monitoring purpose, could be considered as suspense account, or it will at least fall under this by any other name of this, right? So this is what will be the initial assumption as far as we are concerned. But to understand this, we also have to understand a circular issued by the TDS department, that is the income tax department. So it's a circular in 2010, a pretty old circular. So what it says is that explanation which speaks about this crediting to an account holder or suspense account or to in any other name will not apply. So will not apply in cases of banks where credit is made to provisioning account. So if for some provisioning basis, for some internal basis, so for internal basis, its interest is being accounted for just creating a provision, then it could be either on daily basis or monthly basis or whatever period it is. So if it is for the purpose of macro monitoring only by use of CBS. So here also CBS is important. So if this interest that is being deposited, if it is for the purpose of provisioning, for the purpose of macro monitoring using CBS, if it is for this purpose, then it is okay. TDS need not be deducted. So the explanation is not applicable in this particular situation. So whatever we read in this Maya Bank applies to this, right? So applies to this. So similarly, so since no constructive credit, when you say constructive credit, it is actually not going into the holder's account. So takes place by calculating in the CBS software, tax need not be deducted. Need not be deducted at source. So whatever you are doing is an internal process. So constructively, that is, when you say constructively, it is effectively. Effectively, you are not booking the interest into the account holders. You are also not even actually properly calculating. So it's not even actually, whatever you are calculating is only a provision. It's not even the real calculation which has to go to the account holder. So in such case, the circular says need not deduct TDS. So they say if it is a bank, and then if it is credited to a provisioning accountant for what? Provisioning to a current account for macro monitoring purposes using CBS, macro monitoring purposes using CBS. In that case, since no constructive credit is accounted, so no constructive credit is accounted into the account holder, so TDS need not be deducted. This is provided in the circular, and this transaction of Maya banks fall under that circular. So whatever the assessing officer has done is not appropriate. So that's what we need to specify. So, so in such cases, tax shall be deducted at the accrual of interest. So when should the tax be deducted in such situation? It shall be deducted only in a scenario where it is actually accrued. So actually accounted in the account. So it's only on accrual of interest at end of the financial or periodic interval. So the deposit is quarterly, the quarterly period. So point is, whenever it is actually accrued to that account, only then tax shall be deducted. So that's what is say the circular says. So that's what on maturity or income, whichever event takes place here. So in that case, whatever is being paid, bank exceeds the limit of 40,000, TDS shall be. So only in that case, we'll have to come into this situation of whether it is exceeded 40,000 or not. So that's what the provision of says. So in view of the above, whatever the assessing officer has done, that is by disallowing this expenditure of 30% of this interest expenditure, is not valid. It's not valid. Since that is not valid, there is no misrepresentation or underreporting here. So whatever is there, this initiation under section 271C is also not tenable. So this is also not applicable as far as your thing goes. So whatever this penalty under this 271C will also not be considered as far as this question goes. So whatever the assessing officer has done is not valid in the eyes of the law. So, and consequent to that, penalty proceedings also could not be initiated, should not be initiated. So that is also not tenable in the eyes of the law. So this is about this 194A for a specific situation. It is only relating to a situation where interest are not actually accounted to the deposit holder. It is only accrued. It is only provisioned. It is only provision for the purpose of macro monitoring using CBS. So that's the point. So if these are applicable, then TDS will not be deducted till the time it is actually accruing to the account holder. It could be the financial end or the periodical end or the time of maturity or whatever it is. Till that point in time, TDS should not be deducted. So that's his question. So moving on, we'll move on to the question number 3. So this question number 3 is basically Moon TV. It's a television channel. So they are actually making a payment of 50 lakhs to a production house for production of program. So they're actually paying for production of a program for telecasting as per the specifications given by the channel. So it is given by the channel. So specification is given by the channel. The copyright of program is also transferred. So the copyright also lies with the Moon TV. So we need to see whether it is liable to deduction under section 194C. So what is 194C? It is works contract. So it is typically for contract. So if there is a contract, then 194C is applicable. 1% in case of individuals in HUF, 2% in case of any other assessees. Now, what is work contract, right? So what is works contract? So basically works contract is any contract awarded to someone. Now, there are a couple of interesting exceptions to this works contract. One is relating to manufacturing. Another is related to media. So what they're trying to say is, when you say works contract, the person who's allocating that work must be completely involved in it. So typically, it is like, we'll take a manufacturer first. The manufacturer designs a product, and he develops a product. Now, to manufacture this company, that let's take it as A company. Now, this A company is issuing a contract, that is works contract, to let's say B Limited. Now, when doing this, A is also supplying materials, which means design is mine. I have involved in the development of that product. Now I'm asking you to just manufacture. So I'm only asking you to manufacture using my brand, using my design and my material. So it's not just my design development, it is also my material. So my own raw materials, I provide you the raw materials, you manufacture and give it to me. This is kind of job work. This is only covered under 194C. If this is not applicable, 194C is not applicable to that transaction. So when you say works contract, I award you the work along with materials, So only then it becomes a works contract. This is with respect to what you call the manufacturing. Now, same concept we will take in the media industry. Okay, media industry. Now, this is a TV channel. We have this Moon TV, right? Moon TV actually specifies, that is, let's say they are the, when you say specify, we could have it as content creator. So Moon TV is the content creator. So they have actually, when you say content creator, they have actually not created. They have just given you the idea on what exactly you need to create, probably how you need to create. So they're giving the complete specifications of this particular channel. Now this channel, this production work. So this production work. So this is what, if you actually see, this is in line with the design plus material we are talking about. Are you able to link both? Because in 194C manufacturing, we said the design and the material is given by the company to another company. This is job work which falls under 194C. Similarly, this TV channel, the content and the whatever specification is related to that program is given by this TV channel. So this is similar to what we discussed in the above example in the manufacturing. Now this Moon TV is awarding this work to some production house. So it is awarding to it of some production house. This production house, what do? They, let's say, create. They create and give back the rights to Moon TV. It's same as what we saw earlier. B Limited manufactures and B Limited don't sell. B Limited gives back it to A. A only makes the sale. So that's what we call it by job work, right? A subcontract or a job work. So similarly here also, Moon Limited provides this, provides content, everything to this P. P designs, P creates this particular show, creates and then gives it back to the Moon TV. For what? For the telecasting rights. So this telecasting rights. So this telecasting rights is now comes back to the Moon TV. In fact, they're saying even the copyright of this program live with Moon TV. So that's what we are actually saying here. It's a job work. It's a job work. So in this case, 194C applies. So this is what we are referring as 194C. So if you actually see here, that is what has happened in respect to Moon TV. If you have to take a relatable example, let's take this Big Boss show. Probably whatever language you have seen, you probably would have seen or heard about it. Now, this Big Boss program is basically, I'm guess the production house, this Big Boss, this Endemol production or something, but it is telecasted by the Star Network, right? So it is Star Network, or I'm not sure. Let's say in other channels, it could be Colors or something. So whatever channel we are talking about, they don't give the idea. They have not given the idea of what Big Boss is, what is the show type or whatever it is. Everything belongs to Endemol. Whatever is given to this, probably the Star Network, let's assume they only given the telecasting rights. Nothing else is given. Only the telecasting rights. If only the telecasting rights is given, it is not 194C. Because everything is responsibility lies with Endemol. Whatever happens with the Star Network is only making it viewable to the public eyes. That's what they're doing. So that is not job work. So whatever job work is actually, everything is mine. Let's say Star only created the idea of Big Boss. They asked Endemol to produce, only then 194C comes into the picture. So probably this is a more relatable example for this particular question, whatever we are talking about. So if some of you have seen it or heard about that, probably you can link this question exactly with that concept. Next time, if you are seeing, you can also see the word of the producer in the show that is happening. So this is the concept of this 194C. It is only applicable for job works. So now, I'm sorry for this overwriting. So basically the question is, discuss the provisions of 194C. We need to see whether 194C will be applicable in case if they only got the telecasting rights. So in the second situation, they're saying what happens only the telecasting right is captured. So that is the second question here. So we'll see the answer. Basically, in this program, it is produced by the production house as per the specification given by Moon TV, and the copyright is also transferred to the television channel. So the same falls within the scope of definition of work under section 194C. So in this case, it is 194C. It is a job work. So therefore, the payment of 50 lakhs made by Moon TV to the production would be subject to tax deduction at source under section 194C. So that's the point about, right? So it is applicable. 194C is applicable. It could be 1% or 2% depending upon the type of person. If that person is a company, the production house is a company, then it is 2%. If however the payment was only for acquisition of telecasting rights of the content already produced by the production house, there is no contract for carrying out any work as required in section 194C. So in that case, such payment would not be liable. So that's what we are saying. We need to try to understand whether it is a job work or a complete, it's only a limited rights. There is only telecasting rights given to it. So in the manufacturing, only the manufacturing right given. So in that case, no TDS is applicable. So this is how this particular situation arises. So with this, we have completed all the